Hi everyone, a warm welcome and thank you for joining today's session on Making Sustainability Count in conversation with Professor George Serafeim. I'm Brona Ward, a director with KKS Advisors, and we're delighted to be hosting today's session, which will be full of rich insights and practical takeaways. Why we're organising today's event is that as a strategy consultancy specialising in ESG and with our mission to reshape markets, it's really important for us to share thought leadership on ESG issues and bring new knowledge and insights, especially for our clients. And more broadly, we want to spark collective dialogue and conversations about strategic trends and where the future is headed. When it comes to thought leadership on ESG, there are very few people in the world who have the reputation of George Serafeim. George is the Charles M. Williams Professor of Business Administration at Harvard Business School, a globally recognised authority on ESG investing, and the author of Social Impact Efforts That Create Value, which is the lead article in Harvard Business Review's Spotlight series on making sustainability count. We'll be delving into insights from the article very shortly. A warm welcome to George.
Thank you, Bruna. Thank you for having me.
I will dive straight into questions for George. Now, George, you have been conducting research on ESG and the link to financial performance for over a decade now. So what inspired you to bring all of your research together in this latest article, and why now?
I think the main reason is because the world is changing, Brona. And what I witnessed is that many of those issues that we tend to call ESG issues, environmental issues, social issues, governance issues, issues around water stress risk, climate change, waste generation, recycling, and also issues around human capital, the diversity of the human capital, employee-related practices, but also anti-corruption practices, corporate governance, and so forth, were becoming more important societally, but they were also becoming more important from a business perspective. As a result, they were affecting a company's ability to compete, to outcompete, and also to survive over time. And we have seen many manifestations of these issues, right? So we have seen that happening, for example, on the risk side, with Wells Fargo or Volkswagen, and what has happened to those companies that entered into a crisis mode because they failed, for example, their customers, or they failed their environmental standards. And also we have seen the disruption that's happening in many industries. Automobile manufacturers, for example, and how Tesla has disrupted with electrification of mobility. We see the same thing happening in the food market with product reformulation and trying to create healthier products, and all the innovation that's happening there with plant-based alternatives to meat, for example. And of course, we see a massive transformation that's happening in the energy sector, but more broadly in the construction sector and many, many other industries because of climate change. So as I was observing that, not only society was changing, but also those societal changes were affecting businesses and their ability to survive and thrive. And that really motivated me to actually do more work in this area and to start for the most basic premise, which is, can we even measure corporate performance on many of those issues? And what I found there was that we're really lacking in terms of our ability to measure, construct robust and reliable and relevant key performance indicators, KPIs. And as a result, I started my work from that perspective, that if we cannot measure what really matters, then we cannot really focus our attention on what really matters. So I always use this framework of measurement, analysis, creation of value, and then communication in order to guide the efforts in the ESG space.
That's brilliant, thank you. And for anyone who's listening who may not have had the chance yet to delve into the article, can you summarize very briefly, what are the key points and takeaways?
So what I have observed happening over the past decade is that more and more organizations, either on the corporate side or on the investor side as well, have become more and more interested and compelled to actually think about ESG issues, to think about the management of them, to think about resource allocation in relation to them, And how do you drive performance on those ESG issues? At the same time, what has happened is that many organizations that start this journey fail to see real value from their efforts and also fail to see real impact from their efforts. Partly this is happening because ESG is disconnected in many organizations from strategy and from the operations of the organization. So then it is seen as an activity to actually protect reputation, which is of course very, very important, or to comply with existing laws and regulations, which again is very, very important. But other than that, it is not linked to a strategic perspective for the organization. And as a result, because it is disconnected, it fails to deliver what it could deliver. So in this article, launching from a decade of research, I propose what is a synthesis of that research with several actions that organizations need to take. The first one is ESG needs to be viewed through a strategic perspective. This means that actually it needs to be integrated in the strategy and it needs to be core of the organization. And it needs to be thought as a way of actually differentiating the organization and enforcing the unique competitive positioning that the organization has in the marketplace. The second piece is that actually you need to create accountability structures around ESG. Way too many organizations actually, they don't have a persistent and lasting ESG strategy. This is because when things get tough, actually that strategy fails. And as a result, what needs to be done is you need to have both top-down and bottom-up accountability structures. The top-down is coming from the board of directors, and we can discuss more about that. I think this is a very important topic. The bottom-up is actually around the culture inside the organization, a purpose-driven organization where actually employees feel that they're contributing towards that purpose and that that purpose is authentic. The other piece is about making operational changes. There is this, I would say, myth that actually to make more and more progress with your sustainability activities and your ESG strategy, you need to actually centralize all the functions. And initially that works as you're moving from the compliance stage to an efficiency stage, but then actually you need to do the exact opposite. You need to decentralize those activities and make functional leaders responsible for those ESG strategies. And another piece, of course, is actually how do you engage with investors? How do you engage in a way that actually creates a strong relationship and investors really understand what you're doing and why you're doing what you're doing? So they understand how ESG is connected to strategy, and they also understand how this is creating value for the organization, and it's connecting to also the concept of financial materiality. And there, the work that we're doing around impact-weighted accounts, I think, is extremely important in terms of converting those efforts and aspirations into actual outcomes for the organization. So the article is moving us from intentions to outcomes, and it's moving us from a perspective where ESG can be in the periphery of the organization, where actually many of those issues become strategic issues, and as a result, at the core of the organization.
That's really helpful, and I look forward to going deeper in some of those issues as we get later on in the conversation. But to take a step back a little bit, you've mentioned three important letters a few times already, E, S, and G. And throughout this conversation, we will be referring to ESG strategy. So George, just for the benefit of our audience, can you explain what is ESG?
It's a great question because we use that term so much, Brona, but sometimes we even lack a coherent understanding. So for me, ESG, what it is actually a collection of issues that have gained a lot of societal importance, and as a result, they end up actually becoming business relevant and important for business. But how they get implemented is really what is the important point here. The important point is the organization having a sustainable strategy in order to be able to be competitive in the long term by attending to those emerging and current ESG issues. So when we're thinking about ESG, I think we're thinking about a collection of issues in the intersection between business and society. And really, it has gained the importance of a data as well, a data collection exercise. So from that perspective, ESG for me is actually, you could say, the operating framework around business. And then the important concept is whether you can have actually a sustainable strategy, a strategy that actually creates in the long term value for the organization and its stakeholders by attending to those ESG issues.
And you mentioned at the start of your answer that sometimes we are in the space lacking clarity about what ESG is. And this is just one of the struggles in the marketplace in terms of making sense of ESG and then people being able to find a way to make it really work for their organization, which is where your article really comes in to help. But I would like to, at this moment, get a sense of people's views on the call and launch a first poll, which will be asking around which aspects of ESG you struggle with most. So hopefully on the screen, everyone will be able to see the poll and you will be able to select from available answers. So we'll just give a moment for everyone to respond to the poll.
And this is really interesting, Brona, because many of those issues could be happening at the same time within the organization. So I think from that perspective, it's actually really interesting about how each one of them can be important, but also the interconnections between many of them. Because, for example, many times I believe that the general lack of clarity on ESG is leading in many ways to the insufficient buy-in, to the lack of resources and the budget constraints. And as a result, because of that, you're lacking the expertise in order to be able to deliver value.
That's a great point. We have about 60% of the audience have voted so far. Interesting seeing the results come through. Quite a spread so far. I'll just wait until we hit around 70%. And I will end the polling there, share the results on screen with everyone. So what we're seeing is the major challenge that people are struggling with most is at 42% ESG data. We then have deciding which frameworks to use, that's another big one, followed by the general lack of clarity on ESG. So George, do these results surprise you at all?
They do surprise me a little bit, and I want to actually address some of those because this is fascinating. This is super interesting. So I think one of the major mistakes that many organizations are making is that they are letting reporting and frameworks drive strategy instead of strategy actually driving reporting and the frameworks. So for me, in some sense, it's not as important to decide which frameworks to use. That should be actually the outcome of strategic work and understanding where the organization wants to play and how. So for example, if you are having an organization that says that we want to concentrate on our most financially material issues and so forth, then actually you can use the SASB framework. You can actually understand your physical and transition risk exposures from the TCFD and so forth. So I think this is an extremely important point. I have seen way too many organizations that start from the perspective, let's publish our sustainability report, let's communicate our efforts, instead of actually flipping it and saying, we need to actually start from our strategy, and our strategy should be driving our reporting exercise after that.
That's a great point. And just to share some insights from work by KKS Advisors and the High Meadows Institute, we found by looking at company disclosures against frameworks and comparing that with investors, what we saw was that companies typically are using the GRI framework to disclose information, whereas on the investor side, there's a lot more traction with SASB, the Sustainability Accounting Standards Boards. So that's really just highlighting another challenge linked to the frameworks to use, is that companies and investors are actually not always on the same page.
And on that point, Brona, actually there has been a recent effort between all these organizations to actually create a commonality, I would say, about how they are different and how they might be covering some similar issues. And there's a great actually resource that was released just past week between SASB and GRI about how they are addressing different issues. Their definition of materiality is a little bit different, and as a result, they're not competing organizations necessarily, but actually they are satisfying very, very different needs. But I wanted to also touch on the perspective of ESG data, that this is something that we have been working quite a bit. And I want to say that both on the ESG data front and on the framework front, I think there is a huge role for stock exchanges, actually. And I have seen that over the past 10 years, there has been a series of stock exchanges that have taken leadership role and actually shaping their countries. Maybe disclosure guidelines and disclosure requirements. We have seen that in many jurisdictions, ranging from Asia, for example, if you go to Hong Kong and Singapore, to Latin America, for example, in Brazil, the Bovespa Stock Exchange, and of course in Europe as well, with many local stock exchanges. And I think being involved also with the Athens Stock Exchange and there, the CEO of the stock exchange, Socrates Lazaridis, has shown enormous leadership actually. And last year, the stock exchange issued a disclosure requirements framework that has been very, very well received by the marketplace. And one of the things that you see is that it actually creates an environment where expectations are more clear. Expectations about what is it that data is supposed to achieve, what is it that needs to be reported, what is it that needs to be measured, and why. Critically important is the why as well. Why are we doing this effort? It is about capital formation, for example. It's about cost of capital. Is it about competitiveness? What is it that is being actually expected by this exercise? So I just wanted to highlight also that the role of local institutions, such as stock exchanges in this case, can be really, really important in terms of driving some of those barriers, the lowering of those barriers in terms of ESG data. And of course, the frameworks, organizations such as SASB, such as GRI, TCFD, and the Carbon Disclosure Project and so forth, are extremely important organizations to drive that discussion forward.
That's a great point on the role of stock exchanges. And just to pick up a little bit more then on the role of ESG data, one of the things that you mentioned at the beginning of the article is how ESG data is now widely used by investors, and stock exchanges can play a role in trying to bridge that gap between what companies disclose and what is important for the marketplace. And in terms of the investor trends, we've seen, just in the past week or so, UBS Bank coming out and saying that they will be making sustainable investments the default option for their private wealth clients, which is a really big signal of change in the status quo. Can you share a little bit more from your research about the major trends among investors and what's driving them?
Yeah, and some of that, Brona, what you just mentioned, for example, is a reflection of a couple of things that have empowered people to be able to make choices, such as the one that UBS made and that you just mentioned. I think one is that the data has improved quite a bit. It's still not there. It's still not where it needs to be. But for example, if you compare it 10 years ago, it has improved quite a bit. So now, for example, you could find some basic data on scope 1 and scope 2 emissions for a couple of thousand of organizations. Before that, you were not. 10 years ago, there were very, very few. And of course, that doesn't mean that the data is perfect because, for example, scope 3 emissions are still nowhere to be found, right, for most of the organizations. And they're hard to define and, of course, hard to trace both upwards in the upstream in the supply chain, of course, downstream in terms of customer use. And the same can be said for many of the social data that you might find in the space that are lacking even more in many ways than environmental data. So if you try to find, for example, some basic demographics, employee demographics inside the business, and of course across hierarchies, because so much time we spend talking about, for example, diversity, but we don't talk as much about inclusion, for example. So many companies now might report, for example, data in terms of like the percentage of women in their workforce, or the percentage of racially diverse minority set in the workforce, but actually, for example, data about the promotion rates of racial minorities or women, or how they're moving across the ladder inside the organization, are much more difficult to come by. So I think one thing that has happened and has empowered a higher conviction move from the part of investors is that the data over time has improved. And the other piece is that, of course, we have accumulated an enormous amount of evidence now that those issues are financially material issues. And as a result, they need to be measured. The risk needs to be underwritten, or the opportunity needs to be identified. And as a result, there is a connection to risk-adjusted returns, either from the risk side or from the return side on that. And that has been, I think, an enormous has generated an enormous amount of interest from the part of investors. And also, I think something else that has happened, and it's extremely important, is that the role of stewardship in capital markets has been elevated. So I think there has been now a much higher bar in terms of thinking about stewardship and the level of engagement between investors, for example, and investees and the companies that they invest in. And I think what is happening is that investors are realizing that they have a much bigger role to play in terms of stewardship and active engagement with companies. And as a result, that has generated an enormous amount of interest of understanding whether any progress is being made. I think that connects again to the ESG data and whether we can actually measure whether we're achieving any types of outcomes. And I would say on that front as well, we're in the early stages, in the sense that if you actually see what is out there, it's always about intentions and efforts, how many engagements you might have and so forth, much less about the outcomes. And I think in the article as well, I touch a lot about this importance of and this distinction, which is part of what we're working on at the Impact Weighted Accounts Initiative, about the difference between intention and efforts and outcomes. And the fact that, for example, most consumer goods companies might have a deforestation policy, but actually the forest is disappearing. Or many organizations are having a diversity policy, but actually we have a diversity issue. So many times those policies and principles and disclosures and so forth, they might not translate into outcomes. And we need to actually start thinking in terms of outcomes and to understand if we are effective. From the perspective of the board as well, if you think about just from a corporate governance perspective, this is exactly what you want to know in order to be able to hold, for example, management accountable and to empower management to make changes inside the organization and to make the organization more competitive. You want to actually understand whether you are able to drive outcomes, not necessarily the adoption of policies and efforts and disclosures. And this is another important lesson there.
That's a fantastic point. And to enable more outcomes, it's really important that companies do develop a strategic approach to ESG and understand how that's really going to drive value and drive impact. And in the article, your first recommendation is for companies to develop a strategic ESG program. Can you tell us a bit more about how companies can actually go about that task of developing a strategy?
For me, it's a very important point because it goes back fundamentally thinking about the difference between strategy, which is about differentiation and your unique competitive positioning, versus operational efficiency. And that goes back to the work that Michael Porter has done actually in the strategy field in defining the difference between operational effectiveness versus strategy. And I think what has happened over time is that most of the ESG practices inside organizations have become about the operational effectiveness of the organization, which is extremely important. It is very, very important. But I think if you stop there, you shouldn't expect to see to be able to outcompete other organizations and so forth. What allows you to outcompete, and actually, is the link towards strategy. And I think there is no, in some sense, magic wand in terms of how do you get there. But I think there are some principles that we can learn from. The first one is that understanding which of those issues, based on the industry that you are in and based on the business model that you have and the competitive positioning that you have, are financially material for your own organization. And really concentrating efforts on those ones that you are seeing already evidence that, or that you might see from a forward-looking perspective, that they are actually going to affect your supply chain, their customers might be changing expectations, or your own employees might actually be asking you to take a stronger stance on those things. And then some of the work that I did with Gene Rogers, who is the founder of the Sustainability Accounting Standards Board, we try to understand not whether something is financial material or not, but actually how issues are becoming financial material, to introduce that dynamic perspective on financial materiality in terms of an evolution. Because some issues can be now financial material and they can stop being, and vice versa. And that is a reflection of how we all behave. So something that is missing from the whole ESG discussion is that actually whether we can align, you can say, impact and profit, is a reflection of how we all choose our products, our consumers, as employees that work in organizations, our investors, and how we vote as citizens and the regulations that are being enacted. So with the paper with Gene, we basically identify some conditions under which those issues might become financial material. For example, we say that in contexts where actually industrial self-regulation might be less effective, you would expect those issues to become more financially material, as actually companies are not able to manage those issues. And we see that happening in many contexts. For example, think about deforestation and what's happening there, where there has been enormous efforts, but you always have a defection of players because actually the farmers have misaligned incentives, and they actually have incentives to force to escape poverty, right? So another example is when issues are becoming more transparent. And actually technology, for example, has enabled much more transparency right now. So you can actually have a view of the supply chain that even 20 years ago, you were not able to have as an outsider. And this has also elevated the financial materiality of those issues. And of course, other issues, so for example, an entrant, a disruptive entrant that could change the competitive landscape of an industry. You can think about Tesla when it comes to cars, or you can think about Beyond Meat when it comes to basically protein consumption and so forth. So those issues are issues that those drivers are drivers that are changing the financial materiality of a company, and as a result, they require a strategic perspective. Now that being said, and I will fast forward a little bit on the fourth one, Brona, if I may, but actually this tightly links to the need for operational changes in order to ensure that ESG strategy is successfully executed. What do I mean by that? A couple of things. The first one is what I mentioned about you cannot actually implement that strategy by thinking that you can centralize all activities. And then you can think about having, for example, a sustainability department, or however it might be called, that is actually has as a centralized function the responsibility over everything that's happening. That in general works in the initial stages of the organization, when you are thinking about, not really about strategy, but you're thinking about operational effectiveness. And you're actually trying to implement, for example, cost savings initiatives. You might be saving energy, for example. You might be making small redesigns in your operations. And there actually you need that. you need some type of centralized function in order to be able to implement those operational effectiveness. But as you move from what I call the efficiency perspective to the innovation and growth perspective, where you are moving towards strategy, that's where you actually need to start decentralizing the responsibilities around the execution of the ESG strategy to the separate business units and to the separate actually functions inside the organization. That's why you see organizations such as, for example, Unilever or for example, Solvay, that I also mentioned in the article and that I have written a case about that I teach at Harvard Business School. They start actually delegating responsibility to the underlying functions around R&D, marketing, different business units, because then you can actually start having local knowledge that is resting with those functional teams and those business units, and that allows you to implement those solutions and come up with a tremendous amount of innovation in terms of redesigning your products, reformulating your products, the way that you're interacting with your customers. And that allows that perspective. So from that perspective, thinking about strategy and actually moving towards that decentralization is an extremely important perspective. And the last thing that I would say about that is one of the things that we have found is that decentralization can fail when you try to do that. So you need to actually create guardrails around that. And we have found a couple of them to be very effective. One of the most important ones, we have found a very clear and ambitious and transparent target setting around that. So for example, when we studied organizations that are adopting carbon emission reduction targets, we found that the organizations that tend to have more ambitious targets are actually able to complete a larger percentage of the target, although they are more ambitious. And more recently, we have looked at science-based climate targets that tend to be more ambitious and they are aligned with the Paris Agreement. And we have found that those organizations actually make real operational changes inside, and they actually allocate more investment capital that actually ends up having lower payback periods, but actually leads to a much higher percentage of the target being completed and a much larger amount of carbon emissions that are avoided from being emitted.
That's great, thank you, George. And what you've described in terms of organizations going through this process of centralizing and decentralizing ESG, we can see that play out at the board level as well. So for instance, in the early stages, boards might create a standalone ESG or sustainability committee, which is charged with overseeing the organization's strategy and targets on the relevant financial issues. And then over time, they might decide actually that a standalone committee is maybe not the best approach. They might think about integrating it into a risk committee, which is responsible for overseeing all of the risks impacting an organization, including those climate-related risks and sustainability risks more generally that might impact the organization. And so board oversight, you mentioned earlier, is very critical in determining and shaping an organization's ESG outcomes, and it's actually one of my favorite topics. We've researched the board oversight of sustainability with yourself and with Ceres in collaboration on a research project, where we find that strong board oversight of ESG issues is actually linked to companies performing better on ESG. And what that means in terms of having board oversight is having a formal mandate for sustainability in a committee, maybe linking the targets that the organization has to executive pay and so forth. So I'd like to pick up on that role of the board a little bit more with you, how the board can respond to the dynamic material issues as they emerge, and how that can really help shape an organization's strategy, targets and outcomes.
As you say, Rona, the role of the board is an extremely important one. And I think there is the same level of confusion in some sense about the role of the board there. where initially it is absolutely important to actually, for example, set up a separate sustainability committee to actually get the house in order in some sense, in terms of how you think about the governance of all these organizations. But my thinking and what we have found also in the work is that the organizations that have moved towards that innovation and growth stage, and they have integrated ESG in sustainability, they actually delegate the responsibilities about many of those issues to the underlying committees and to the central board. So for example, I think it's extremely important that all the ESG data that are being communicated by the company and that are measured inside the organization are part of the audit committee. These numbers are extremely important. Most of the ESG data are not even audited. So the audit committee needs to assure the integrity of those numbers since they are being communicated. If they are important, if they are financially relevant, why wouldn't you want those KPIs to be part of the audit committee work? In the same way, I think about the compensation committee. I think if there are ESG metrics that are actually driving the execution of the strategy of the organization, you would want the compensation committee to actually have a rigorous thinking about which those should be, and then link them to short-term and long-term incentive compensation for management in order to drive the organization forward. So you can actually start thinking about consumer good companies, such as PepsiCo and Coca-Cola as well, that are all actually trying to either make operational effectiveness changes, for example, improving their water ratio that goes inside their beverages, and how they can actually reduce their water footprint. That's the classic operational effectiveness, to issues of strategic pivoting, where actually they are trying to reformulate their products and change the product portfolio towards fun for you to good for you, right? As it was the saying going at PepsiCo. And there actually, you need to start thinking as a compensation committee about how do I incentivize management to pivot to the new business model and to the new set of products in an effective way, right? So from that perspective, we need to start thinking also in terms of board governance, and this is what leading organizations have done, about how you can actually start delegating those functional roles, you can say, to the different board committees, instead of saying, well, all these ESG issues are actually part of a separate line of work, which can work initially, but over time, if you really want to move towards that product innovation and growth stage, you actually need to start integrating into the functional roles of what all these committees are doing.
Yeah, and the role of the board is also essentially the top-down process. And a lot of your research, and you touched on it in the article as well, is embedding corporate purpose throughout an organization so that everybody really understands what the purpose of the company is in relation to ESG issues and how those drive value creation at every level. And I'd like to just, on that note of corporate purpose, launch our next poll, which is asking our participants, which companies do you expect to have a stronger purpose? Do you think it's more likely to be publicly listed companies, the large ones, the kind of small to mid-cap ones? Do you think it's more that private family-owned companies are able to have a stronger sense of their purpose, maybe because they're smaller and there are less shareholder pressures on them? Or is it private equity owned companies where maybe private equity investors are able to engage with those companies thoughtfully and drive forward their purpose? So we'll just give a moment for more participants to respond to the question. And I'd highlight as well here on the topic of purpose, we are approaching the 50-year anniversary of Milton Friedman's very influential statement that the purpose of business is profits. And actually the conversation that we're having today is all about how environmental, social, and governance factors can drive value creation. So, George, maybe you have something to say on that topic too while we wait for the result.
It's actually a spot-on question because we have a very recent paper that we have been working with Claudine Gardenberg from the Wharton School of Business that actually provides some answers. I will, before I give it to that, I don't want to lead the witness in terms of what we find there. And we don't differentiate exactly as you have it in terms of large cap versus small and mid cap, but we have some of those dimensions. And I want to say that this is an incredibly important point. Let me start by saying that in terms of corporate purpose and why we think it's extremely important is because senior management can make all these high-level statements, but actually that's not what purpose is. We actually know what purpose is not. Purpose is not the words that you see on the wall when you enter the headquarters or the grandiose speeches in a town hall, a corporate town hall, and which are great, but that doesn't mean that actually that purpose is lived inside the organization. And throughout the years, we have seen an enormous amount of skepticism inside organizations in terms of the lower level employees and how they view those statements of corporate purpose. So what we did in our research, we actually went and looked at data about how employees that know the organization the best because they live the organization day to day feel about the purpose of the organization. So instead of going towards statements on websites and so forth, we actually looked at through very large survey instruments inside organizations about how employees live those organizations. And actually reflecting on the poll that I see here as well, what we found was that the strongest purpose was found in private family-owned companies. That was one of the things that we found. And then it is a super interesting result, but what you actually find for publicly listed companies is that ownership matters. And the type of commitment that you are getting from ownership, it matters quite a bit. So in general, we found that for publicly listed firms that tended to have an ownership base that was more long-term oriented, holds the stock for a longer period of time, has a higher conviction in terms of the investments that they are making, holding less broadly diversified portfolios that are not just hugging the index, for example, actually tend to have pretty similar to a private firm type of purpose. And the purpose declined for organizations that actually were publicly listed and they didn't have actually that commitment from their investors as well. So commitment is an incredibly important, I think, element of when we're discussing about purpose. And if you think about it fundamentally, this is what the employees want to feel at. They want to feel a commitment from the perspective also of senior management. And what I say in this article is that in order to be able to execute and integrate your ESG issues into strategy, you need to have both the top-down force from the board of directors that we're discussing before, but you also need to have the buy-in broadly inside organizations. Because part of what we found in that purpose research is that actually that buy-in tends to drive future financial performance if it is diffused inside the organization. Actually, middle management buys into that sense of purpose. And if there is no buy-in, actually we don't find that this culture sticks.
Fascinating, George, and thanks to everyone for sharing their views on corporate purpose. Last question from me before we get the questions for the audiences is, so you've gone through many of the features of this 5-pronged approach that you outline in your article, and we do have many company representatives on the call today who might go back to their organizations and think about how they might implement these recommendations. So let's say they do all of these 5 points. What kind of results can they expect? Will they have happy investors? Will their stock price go up?
It's a great question, Brona, and it's hard to overgeneralize, right? But I would say there are a few things that I think will start happening inside the organizations, and some of those benefits will start accumulating. The first one, once you start thinking about actually strategy, competitive positioning, and differentiation compared to your competitors, you will actually start finding opportunities for value creation that are non-table stakes inside the industry. So you will need to start thinking differently about how you do business, how you operate, and importantly about the impact that your products are having and how product impact is actually being felt by the customers and the broader communities. The second thing is that discussions are going to start inside organizations with different functions and different units because people want to be engaged, people want to be involved. They just don't want to be told what to do, but actually listening and starting a discussion inside the organization. This was a huge actually learning, even if you think about an organization like Walmart, for example, and setting up a science-based target and how it starts basically a discussion inside the organization about, okay, how can we actually improve, for example, our superstores in terms of meeting actually those science-based climate targets? What is it that we need to change in terms of how the stores operate, in terms of how the stores are structured, existing stores, but also new stores that we're going to put out there, right? So if you actually start having that discussion from the sustainability department, for example, with the real estate department, with the finance function to understand capital budgeting, what might be some of the barriers there, you actually learn a lot. The same thing can be found also, for example, in an organization like JetBlue. I wrote a case on the organization. One of the things that I learned was that basically how the chief sustainability officer there actually started communicating with the crew members, for example, in terms of actually implementing behavioral changes, how it started actually interacting with the finance function to understand capital budgeting. Or even if you go to one of the single most important issues in aviation, which is basically the cost structure that's coming from your fuel and the ability to lower the carbon profile of your fuel, how you actually needed to have some systematic discussions to understand why, for example, renewable jet fuel might not be cost competitive because of transportation costs. And actually, when you start talking to people, you find new ways of lowering those transportation costs, and then you end up actually signing one of the biggest contracts for renewable jet fuel that is actually cost competitive. So some of those things, I would say one of the tangible benefits is actually innovation, new ideas. And I think over time, what you find is that you can actually start aligning your strategy with what your vision might be. And once you do that, you can actually start having an accountability process, both inside the organization, but also with your investors as well, where actually investors can actually start tracking outcomes to see whether you are on track and how financially material those issues might be, how you're changing your operations and how this is impacting your organization. So I would expect to see a higher effectiveness and improvement in terms of productivity inside the organization. I would start to see, and that could be more in the short term. The other one that is more medium and long term, new ideas that generate actually a wave of innovation, and some of them might be process innovation, some of them might be business model innovations, some of them might be product innovations, and that should flow in the capital markets. And at least in our work, we have found that those organizations tend to have actually higher valuation multiples, market to book ratio, for example, in capital markets, and have preferential access to finance as well. And we see an enormous amount of innovation also with new financial instruments, such as sustainability-linked loans, sustainability-linked bonds, the NL1 that was launched, of course, a tremendous amount of green bonds and other such financial instruments. And I think, to be honest with you, this is just the beginning. I think we're just in the beginning of that wave of innovation, both inside the organization and also in markets.
Thank you. And now we'd like to move to open up some questions from our participants today. So I'm just bringing on screen some of the questions that we're getting through. The first one for you, George, is we've talked a lot about the different reporting frameworks and the role of ESG data. One of our participants would like to know, what is the role of the impact weighted accounts initiative that you mentioned earlier? in this world of different frameworks and ESG data?
Yeah, it's a great question. And I would say that impact-weighted accounts is a research initiative. It's not, you can say, a reporting framework or anything like that. It's actually an effort to move towards more outcomes and start understanding outcomes. And it's an effort to actually do research and create impact transparency in the marketplace around three fundamental pillars. One is the environmental pillar, the second one is employment, and the third one is product. And let me touch on environment is something that we all understand a little bit more, but I think the other two tend to be much more complicated actually. So employment, for example, what does it mean for an organization to have a positive employment impact? What are the dimensions that one needs to measure, and how those dimensions are getting integrated, and as a result, how can we measure those things? So for example, we have been working on a framework, and actually now we are in the process of applying that framework in multiple organizations and measuring the data with my colleague Katie Panella there at the impact-weighted accounts, where we basically say, how can we understand the quality of the wages that are being supplied in terms of whether those wages, for example, are above living wages and so forth? What is the quality of the benefits that are provided to an employee in terms of childcare support, in terms of sick paid leaves? What does this mean? So we're taking each one of those dimensions and then we're linking it to science. For example, we can say that if you don't provide to your workers enough sick paid leave, then actually the probability that they are sick and they are not going to the hospital increases. What is that cost from a health perspective, right? We can actually measure that, and then we can link it to the provision or not of the benefits from this organization. We're also looking at issues of diversity and opportunity, for example, in that employment space. So what does it mean if you don't have a diverse organization? What does it mean if you don't have an organization that provides opportunities to employees? What does it mean if you have accidents or actually mental stress inside the organization and so forth? All these have actually either social benefits or social costs tied to them. So we're actually creating a framework where we can measure that systematically, and then we're releasing publicly all our insights, all our analysis, and all our data. And the same thing on the product side. And product tends to be very, very idiosyncratic. Of course, on the product side, we're looking at actually how the product is being used, how it is consumed, not actually what are the policies of a company. And I would say also product impact is generally a blind spot of the ESG data. There isn't much about product and the impact that the product is having. So where, for example, we are looking at if you have a consumer goods company, for example, what is the relative proportion of sugar versus sodium versus whole grains that is being provided by the products. If you have actually a pharmaceutical company, we're looking at actually the effectiveness of the different drugs, looking at medical studies, and then we're looking at actually what is the underlying disease that is being addressed to with a pharma. And the same thing if you have, for example, automobile manufacturers, we're actually looking at maintenance cost and fuel efficiency and actually safety features inside the vehicle, and then we're understanding actually what are the social benefits and the social costs from that. And of course, when you're supplied that product, what is the value of mobility that you're providing to your customers? So we're going to those fundamental, I would say, attributes of a product, and then we're actually monetize them and we're reflecting them in dollar terms. Once we can do that, then we can actually start having an integrated view of performance. We can start having, for example, impact-weighted earnings per share that we can actually analyze and really understand which organizations are truly creating value and which organizations are actually extracting value from society.
Excellent. And we have about 5 minutes left on the call. So let's try and get through as many more questions as we can, because there are lots coming through from the audience. The next one...
I'll try to be very, very short.
Excellent. We'll have a quick fire round. So next one is the COVID crisis and AI developments have made it very clear that more focus needs to be placed on human capital management. How do you think companies should go about it?
It's an extremely important and extremely difficult question too. I will point to a paper that we wrote recently with Sakis Kotsadonis that is named human capital and the future of work, implications for ESG investors. If you just Google it, you will be able to find it. And there, what we did is basically we looked at the probability of automation of different tasks for different occupations, and then which of those occupations exist in each GIC sub-industry. And we found that actually there is a tremendous variation across them, and this is what we're witnessing now with the COVID-19 crisis, because that maps pretty well with the people that have been fortunate enough to be able to go home and work from home versus people that have to be out there, that have to actually work out there. And of course, the latter group has been much more affected by this COVID-19 crisis. So I think organizations that are looking at the future of work and human capital need to think hard about what are the skills that workers will need in order to be able to compete in the future, and then actually what are the skills that they will need as organizations to be competitive in the future. And I think now we're in the early stages where we're trying to understand that, and that framework and that paper might offer a few ideas there. And also we outline an engagement framework for investment organizations that might want to engage with companies in that journey.
Thanks. And thanks to everyone who's been submitting questions. Lots of great questions coming through. I'll go next to a question from Louise, and I think this one will resonate with a lot of people on the call and working in the ESG space. How can you drive outcome at the company level when there are so many different factors to just one issue?
I think it's possible, but it requires a lot of hard work, right? So thinking about actually an organization that is trying to drive outcomes, I think you just need to engage the people inside the organization that have the most lever on those outcomes, right? So if, for example, you're trying to actually drive outcomes about diversity of the workforce, you need to actually engage human resources. If you're trying to drive outcomes when it comes to an industrial production, for example, you need to engage the chief operating officer, for example. So I think finding those pockets of lever inside the organization and building a coalition actually and clarity about the future action is extremely important. And the one thing that I would say is that in many ways, we always have this debate between incremental progress and transformational progress. And I think sometimes we tend to think about transformational progress always as the good thing and incremental progress as the bad thing. And the reality is that inside most organizations, actually, if you start and you go to someone and you basically pitch the stars, you actually end up achieving nothing. So I think it is extremely important when you're trying to see outcomes that actually you go and you create quick wins so people can see a path for progress. And from that, you shoot even higher. You become more and more ambitious as you move forward.
Thanks, and we have just about run out of time, so that will conclude our session today. I want to say thanks to everyone who has joined us, and thank you, George, for all of the insights, and a big thank you also to the KKS team who've been working behind the scenes to make today's event happen. If you have enjoyed today's session, then there are a number of ways to stay in touch. On screen, you can see our Twitter at KKS Advisors and at George Serafeim. You can also find us on LinkedIn and by contacting us directly over email at info@kksadvisors.com. We hope you've enjoyed today's session. Please do read the article. It's full of great insights, and more broadly engage with us on this important conversation around ESG and share what you learn with your colleagues so that we can collectively drive progress on ESG and move towards a more sustainable future. Thank you very, very much, everyone, and goodbye.